Okay. So Chris Silverthorn, thanks for joining me.
Pleasure.
Thanks for going on this podcast adventure with me, which I haven't done before. You haven't done before, so this could go one of two ways.
So I'm the first.
You're the first, man. So we have a few weeks lined up here, but yeah, I was excited to talk to you guys. Obviously, I know Stuart, who's your VP of Business Development at Provida. So Provida is a factoring company. But maybe you and I have had a 5-minute conversation. I don't actually know all that much about you.
Right, yeah.
Do you want to start with who you are, where you came from, how you got here?
Sure, yeah. So I'm at Alberta, born and raised. Moved to Calgary when I was 19 years old, and from small town Alberta. Stayed. Liked it here. Decided to make a home of it. By way of kind of how I ended up where I am today career-wise, it was kind of through the route of financial planning into oil and gas finance, into some commercial banking, and then I stumbled across the concept of factoring while I was a financial planner. There was a presentation. A factoring company was raising money for through a fund, and I was just intrigued by the concept of factoring and alternative debt in general. And at that point, which would have been about 2010, I was hooked at that moment. So then the next, 5 years or so were spent pointing my life in a direction where I would end up starting an alternative debt company. So I did a stint at the Bank of Montreal, left and did, similar to what you were doing, kind of debt restructure brokering and with the intent of starting the private lending company. And then I was working on a specific file, moving a company from special loans at one bank into, there was another bank that wanted the business, but there was going to be a 6-month gap. And at that point, I tapped the shoulder of a lawyer friend and an accountant friend, and we got some money together and did our first deal based on that. So we just kind of, rather than taking it to a factoring company, we factored that deal, and the company has grown from there. So that would have been about 2015, late 2015, early 2016.
So what's the process like in that situation where you're raising funds? I mean, that's private money. Like, that's a little different than just going to a bank and asking for a loan. I assume that's not a simple exercise, not to mention just having to convince somebody that you're worthy of their investment.
Yeah, it was. I mean, we started real small, right? One deal, and it was very close. At the beginning, it was very close, kind of family money. And again, we grew from there. So now our funding source is a network of high net worth investors, and it is just a matter of delivering on your promises. We pay a monthly coupon to the investors, and they're happy, and we like them, and it's a good relationship. So yeah.
And so you spent a year in commercial banking?
Yeah.
And you actually got out of there in a year?
That was the plan.
Jeez. So I was in commercial for 13 years. My plan was to get out after 2, but
yeah.
God, life happens.
Yeah. Yeah, there's a longer version of that as to why I was able to get out when I did, but yeah. It worked out somehow. I just, like I said, came across this thing in 2010, and I made it happen a few years later. So,
what was the environment for factoring back then compared to now? Because now there are several providers, obviously. Mm-hmm. They all differ and maybe slightly in one way or the other, but what did the market even look like for factoring 12 years ago?
12 years ago.
Well, that's how long it was, wasn't it?
Yeah, when I stumbled across the concept.
Yeah.
Kind of similar to today, although perhaps a little more disparate, meaning there were some big ones, and the group that I saw the presentation for was a larger factoring company, and then ton of mom and pops, and not much in between. And that's where we fall. And there are more of the in between sized guys now than there were back then. Definitely.
By in between sized, are we talking about like their fund size or the
loan? Yeah, I mean, I'm really focusing on their average loan size,
Okay.
the deals that they're going after.
Yeah.
So it was either, 3 million and above or 50,000 and below kind of a thing. And
Right.
and at the time, at least from my perspective, not a lot in between. Yeah.
Right. And so Provida has been in business for, is it 5 years?
Yeah. So officially since 2016.
Okay.
Yeah, 6, almost 7, I guess. 6 years.
Okay.
Yeah.
And so how many people are on the team with you?
There are 6.
Okay.
Yeah. Yeah. Myself and our chief operating officer are the two main kind of shareholder decision makers, and we've got Stuart and a controller and a couple of admin types. So.
And so, like I had said, there are several factoring solutions out there. So put size, like ticket amount or ticket size or whatever the number is, put that to the side for a second. How does one factoring company distinguish itself from the rest? Because you think about, like, from my perspective, a business comes to me where we look at it and we say, oh, factoring might make sense in this particular situation. Ideally, we're not wasting certain lenders' time by sending them a deal that doesn't make sense to them, right? So we're trying to figure out, which factoring company makes sense for this particular transaction. How do you distinguish yourself? How does Provida distinguish itself in that situation? Does that make sense? That was a long-winded lead up.
Yeah, I mean, at the end of the day, factoring is factoring. There are I guess varieties. There are, some factoring companies will only do what is called full notification, meaning when you've got a borrower, all of their customer base knows that they're factoring all of their receivables.
Yeah.
And then there's non-notification. We do a lot of non-notification. Some factors will only do notification. That works for some borrowers. It doesn't for others. So that would be one way that you would decide on one or the other.
So maybe more basically then, for people that aren't super familiar with the process, like most people are familiar with a borrowing base, right? Like you'll borrow against some receivable at a discounted amount. How does factoring differ from that? And when does it make more sense than a borrowing base?
So factoring is for companies that, well, I guess there's two answers to that. In my world, factoring is for companies that basically aren't bankable. So either they and they can be just outside of bankable, ideally, not really not bankable. So either it's a new company growing quickly with a bunch of great customers, so they don't have enough financial track record for the bank to take them on. We will work with companies who are current borrowers with the bank in good standing, but they had a mediocre year last year and they've suddenly got a new customer and their working capital needs have accelerated, by 50%, let's say. The chances are, the credit group isn't going to be comfortable with increasing the operating line to support that. So in those cases, the bankers will come to us and then we'll carve out that particular AR and lend alongside the bank. And then the third scenario is restructuring special loans scenarios. So for one reason or another, the company is in special loans, offside with the bank's covenants. Good management team, good customer base, had some issues for a while. They're righting the ship, but it's time for them to exit the bank. So we'll come in and take them. What all of these companies have in common is that they'll only be in this position for a certain period of time, and then eventually they're going to go back to one bank or another. So that's where we play, is the just outside of bankable. We kind of help companies and the banks in those scenarios. There is another version of factoring that some of the banks do themselves that is, let's say it's priced the same as an upline, but it's more for companies that are seasonal. So there's a lot of ups and downs in their revenue. So that basically the bank is, tying that upline directly. They are factoring, but they are a bankable company that just has different needs than your typical upline can provide.
I was surprised. Ashdown has several HSBC guys, and they were saying that HSBC actually does some form of factoring.
They do, yeah.
So is that what you're referring to?
I try not to name names, but the bank I was thinking of in this case was HSBC. Yeah,
I'll have to see. I'll do better. So what's the process actually look like if you're going to factor for a company? When you guys buy a receivable, there's a verification process, obviously. Stuart was telling me about it, and I didn't even know what the invoice documentation process looked like on the customer side. So I found it kind of insightful. But do you want to talk a bit more about what that actually looks like?
Yeah, absolutely. So many, you think of not bankable and you think of, okay, this lender is a higher risk lender. And I would argue that we will take on what traditional lending would consider a higher risk borrower. But because of the policies and procedures that we put in place, I wouldn't necessarily say it's a higher risk lender, if that makes sense. Mm-hmm. And so some of the ways that we kind of mitigate the risk of, again, what is a higher risk borrower would be the strength of the AR of their customer base. And so how we do that is, so specifically, I'll just run you through this scenario. Borrower does work for a customer, let's call it $100,000. Work is completed, they submit the invoice is approved, and so I'll get into the specifics again of what that looks like. To be paid in 45 days, we advance, let's say, 85% of that invoice amount. 45 days later, the customer pays us through something called a blocked account, which is an account that we control that's in the borrower's name. Mm-hmm. So that's that non-notification thing. So before we ever advance on that invoice, we need to know that it is approved to be paid. We take out the performance risk. We take on the risk of time rather than performance. So the ways we do that is either the borrower will provide us with login to an invoicing software platform. Like we just get a login, they submit an invoice, we log in, look, yep, it's been approved by the customer, good, we can advance against that. Another way we can do that is just simply by signed field tickets. This would be specific to oil and gas services. So they can submit signed field tickets to us to verify that the work has been completed. So that's signed by the customer. The customer has signed a ticket saying, yep, this work has been completed. And another way we do that is just an email. So the borrower will send an email to the customer with us BCC'd on the email, and the email will say something to the effect of just writing to confirm that invoice number X has been approved for payment and will be paid in, as per terms or whatever. And then once they get the reply from AP, they'll forward that on to us, and then we'll accept that. So we don't advance against an invoice without some version of that.
Okay. Did you say on non-notification, the the customer, the invoice, the name on the invoice, I guess, they still think they're paying. They're not aware of the factoring as well.
They are not aware.
Yeah. Okay. I would assume that by and large, that's what most businesses would want if they were to borrow by way of factoring.
In our experience, yes.
Yeah.
That is what most of them want.
And is it there's my sense is like people are worried that if their customers think they're factoring, then there's some credit, there's some concern about the business itself.
Yeah, there's
is that kind of right?
yeah, the stigma that the company is financially weak, and a lot of large customers don't want financially weak vendors, suppliers.
Yeah, right.
The kicker there is that it's the long payment terms that are doing that to them.
Sure.
So it's a pinch point for these companies, right? And we come in and ease that.
But so for the ones that are on notification, so everybody's aware that factoring is a feature. Like, how often is it that the customer, so I know we're screwing up customer and vendor, but I mean the company who's going to pay the receivable, like how often is it that it's that much of a sticking point when they learn the factoring's involved?
I don't know. Some large, let's say, oil and gas producers will say you cannot factor.
Really?
Yep. Walmart has allowances for factoring in their contracts, so Walmart is completely okay with factoring. So it's a kind of all over the map, and probably based on experiences that individuals have had with factoring in the past, one way, positive or negative.
Why would they be opposed to the factoring? Like, isn't it kind of, to your point, like it speeds up the cash cycle for the vendor? Like, it kind of helps them.
Yeah, I've got to think that apart from the general sense that we don't want financially weak vendors, maybe someone over there dealt with a bad factoring company and had a bad experience and decided, nope, we're not doing this anymore. Like,
and so that's just supposed to like naturally kind of rule out some companies that are otherwise going to use factoring.
I'm guessing.
Yeah,
I don't actually know, but the larger the company and the longer they stretch out their payables, the more factoring makes sense, right? For these vendors.
It was such a, especially here in Calgary, like that is such an issue with like oil field services. Mm-hmm. You have this huge disparity between the size of the customer, massive customer, and the size of the services business. It's pretty fragmented. Most of them are pretty small. Mm-hmm. Mm-hmm. And I think they're still on net 30-day terms or whatever it is, but they're going to get paid 90, 120 days, and they'll get paid when they're good and goddamn ready. They'll get paid, right?
They'll get paid.
But they have to ride out some pretty long payment terms sometimes. And, again, these are small companies that don't necessarily have the liquidity or the strength to endure that.
Yeah, well, there goes we'll sometimes come across 120 days.
Yeah.
And Stuart has this, analogy when it comes to that, comparing that to, imagine if you personally were paid every 3 times a year. Mm-hmm. Like how well would you be able to manage your cash flow?
I'm barely hanging on now. It's true though, right? Like you still got to pay. You got to pay your people, let's say biweekly or whatever it is, and you got to pay your utilities monthly or whatever it is, and so it's unfair, but it is what it is. So that's a situation where I can see a scenario where factoring makes sense, especially if you're talking about 120 days. Because if you do have an operating line, and let's say it's margined, they're not going to count unless it's EDC insured. Like they're usually not going to count over 90 days.
Yeah.
Right? So.
Yeah, exactly. And again, I mean, these scenarios that we talk about, I mean, that's why operating lines do exist. But factoring is for the times when a company needs working capital assistance and can't get an op line.
Right. So you mentioned earlier that there are instances where the factoring and the operating line might actually work. They might actually work concurrently, right?
Absolutely. Yeah, we do those.
So you'll have a subordination agreement for, I assume, specific receivables that you guys would be.
Yeah, it tends to be a specific customer. For example, that's sort of the cleanest way to do it. So you've got the bank with, let's say, a $5 million op line, and the customer lands a new client. Basically, we would carve out that new contract and landlord. And we've done that a bunch of times.
Have you ever run into situations where, I don't know why they would be, but where the lender is just kind of resistant to the idea of a subordination? Or they cut back the line because you're taking some of the receivables over for them?
We're almost always brought into the situation by the lender.
All right.
So, and the times that we've been brought in through, I don't know, a broker, let's say, we try to make it very clear that we work with banks all the time. So if they don't know us, we try to figure out a way to make ourselves known. Like, hey, here's who we've worked with. We do this all the time. This is how it works. As long as we're not compromising their security in any way, as long as they don't look at the situation and see it as not beneficial to their customer, they're generally fine.
So in that instant, and maybe it doesn't, I guess it depends. Like, do you ever run into instances where, because you're taking over some of the receivables for them, they actually scale back the operating line limit or anything like that?
I've never seen it.
No.
Again, we go, again, second on the GSA, and then very clear division of AR.
First on these particular customers.
Yeah.
And how do you guys manage the credit risk on these customers? I mean, I don't assume you're only doing investment grade names.
No, but I would say only sort of known, household type names. Maybe not investment grade, but if we haven't heard of, again, it depends on the makeup of the AR. How much, some of the AR list will be investment grade. Some of it may be mom and pop. Some of it may be somewhere in between, a large junior producer, let's say. We do our best to find out what we can about each customer via just straight simple Google searches, Dun & Bradstreet reports. There's info out there. In some situations, if it's a basket of AR that is, we don't have complete comfort with, we'll use AR insurance. And if it can be insured, if it can't be insured, then that tells us something about whether or not we want to do the deal.
Okay, so you can't get AR insurance on necessarily everything. Okay.
No, those AR insurance underwriters know, they know what they're doing.
Fair enough.
They're good at what they do.
Okay. So are there industries that you guys won't touch, or is it entirely based on the credit quality of the customer?
I would say it is entirely based on the credit quality of the customer.
So construction, as an example, like progress draws, are those challenges at all?
They are more work to get comfortable with. It depends on the customer themselves, even the borrower. We'll do it though. It might, if we don't like what we read, we may not do it, but it's not off the table.
You're down for anything. That's the soundbite for this episode.
Yeah. Provida, down for anything.
So you guys are out. Obviously, you're promoting factoring. You're meeting companies all the time. Are there common objections that you faced, or common questions that you kind of see more than others?
Just a bit of education. So we actually only market really to bankers,
Okay.
advisors, brokers.
Okay.
We do not market directly to the companies themselves.
Okay.
It is we've built a name in the Western Canadian lending landscape. But outside of that, no one knows who we are, right? And most companies haven't heard of factoring. So what we do is we're continually in front of kind of financial professionals with customers who may come up against situations where they need factoring, and we educate them because it's a much quicker education than it would otherwise be.
Yeah, you don't have to start by defining what a receivable is.
Yeah, exactly.
Not to be disparaging, but
we get the odd kind of lead that comes in, company direct to us, but generally it's all referral. Yeah, we don't do any direct marketing. So I guess I could say, so once we get to the point where the introduction is made and we're having conversations, it is real different. It's different than an upline. So, some of the early objections are just that it's different. I'm not used to this. I've got I have to do what with the blocked account?
Blocked accounts can be a real hassle for some banks. Maybe all banks. I don't know. You tell me.
Yeah, there's a couple that can do it, and most can't. Without naming names. It can be. Yeah, they can be a struggle to get set up. Yeah, but we use them all the time, and we've got a couple banks that we can rely on to get them done.
So when you're in terms of your BD efforts, I mean, is it as simple as you just got to stay top of mind, and if so, what does that look like? Is it just constant? Stuart's just constantly out with coffee, lunches, and beers?
24/7, yeah. That is
he seems good at it.
He is good, yeah, he's great at it. Yeah, I mean, the deals happen or they don't, right? And it's just a matter of when they happen, you are who the banker or the accountant or the broker thinks of.
Yeah.
Because there are other options, so it's...
Mm-hmm.
And so it is. It's a matter of just being out there in the marketplace all the time. That's what we do.
You know what I like about Stuart? We've tried to give you guys a few looks on some stuff, and mm-hmm. I like how accessible he is.
Mm-hmm.
And I don't think his background is banking necessarily, but he does a good job at really boiling this stuff down
mm-hmm.
in really accessible language. Do you know what I mean? Because I find that we were talking about this before we started this episode. There's something to be said for communicating complex concepts at a third or a fifth grade level. It requires a higher order of thinking to do so, but especially for me, who doesn't necessarily live factoring, and I'm trying to. I mean, I can't spend weeks trying to figure out a concept.
Mm-hmm.
I got 2 young kids. I'm hanging on by a thread over here.
Mm-hmm. Yeah.
And I really like that about him. So it makes it what the value of that is. He usually ends up being the first call when I have something and I'm trying to make sense of it.
Mm-hmm.
We haven't been able to make one work yet, but it's quick. I just really appreciate that.
Mm-hmm.
Not everybody is like that. It can take other people a really long time to get there. So
he's been a great addition. He started right before COVID hit.
Where did he come from? Do you remember?
So his background is actually quite diverse. So he graduated from engineering. So he's a P-Eng.
Okay. Which is weird.
Yeah. worked for Halliburton, traveled the world working for Halliburton, and then he got out of that, got into apartment REITs. So he built up an apartment REIT with a partner, and then left that partnership. And he was in that real estate space for a number of years. But he's a well-educated guy, PNG MBA, a wealth of business experience, and humble. And he didn't speak bank, so that's what he had to learn. When he came on board, he had to learn to speak banker. So he did, and he's been a great addition. Absolutely, yeah.
Both of you. I mean, if it'd be impossible to summarize your backgrounds in a single sentence. Because I even before this, I was trying to make sense of your LinkedIn. Like I do what I'm supposed to do. I creeped you on Google and LinkedIn,
Absolutely.
and I mean, you're all over the map, like,
Yeah.
which is a compliment, right? Like I compare it to myself. I mean, I did the same. I'm still doing it. I mean, I'm more or less doing the same thing after 13, 14 years, and it never occurred to me to do something different.
Right. Yeah.
But you have, I mean, again, you kind of alluded to it. You have some commercial, you have some capital raising.
For me, I needed to start my own thing.
Yeah.
I knew that. But I needed to kind of gain the experience and find the path to do that. So eventually I figured it out. But I knew one day I wouldn't be working for someone else. And that's what guided me more so than anything else. Okay.
Is it the ability to take instruction? Is that what it is?
No, it really is the need for what I do day to day to matter.
Yeah.
The larger the company, it's the more of a cog you are. And I didn't know this would get so philosophical. But that is what drove me to kind of figure out.
It's a 3-hour
Right.
podcast.
We got a lot. Yeah. But yeah, that drove me more so than any desire to be in any one career path was, okay, what can I figure out that I can do that's going to get me where I need to be. So
it wasn't some preordained path necessarily, like you were just taking opportunities as they came, right?
Yeah.
Yeah, there's something to be said for that. I mean, when you're in banking, it kind of there's a prescribed path if you're going to be in commercial lending, let's say, right? And analyst, account manager, relationship manager, credit manager, all that stuff, and it's a wicked experience. It really is, right? Like I did that stuff. I kind of came to a point where, every couple of years you'd feel this urge to want to do something different. And it comes and goes, right? You kind of get over it. Maybe you get a promotion and then you move on. And then the feeling comes back. And I was just worried about, God, I'm 37, which isn't old, but like time's passing, right?
Yeah.
So little kids, and I just felt like it wasn't going to get any easier to make a change. But I had such a hard time thinking about what other opportunities I might do while I was in the bank, because you don't have any bandwidth at the end of the day. And so my wife was kind enough to agree to let me walk.
Right. Yeah.
And I just needed some time. I just wanted some time to think, right? So it took a couple months, and it was a longer story there, but it took a couple months, and I saw value in a banker that advocated for the business a little bit more, only because, like, if you're a business owner, like, you got a million things to do plus a podcast. Commercial financing can be just kind of an onerous process, right? So if you're not doing it for a living, and so I kind of like the Ashdown guys because of that. Like, plus they're clearly their business model kind of works in BC. We just kind of have to build some brand awareness out here, which is part of why we're here. But
right.
But anyway, I digress. Timing in terms of closing, like getting introduced to a factoring company and closing the financing, like what does that timeline look like?
I would say on average a month. We've done a deal in 9 days. But
9 days is best case, though, I assume.
Best case, yeah. Yeah, I would say on average a month. It takes some time to, get the information, get the blocked account set up.
Is that a lot of the time?
It's a chunk. Yeah, for sure. That definitely takes a couple weeks. So we try to start that process as early as we can. But you need to be to a point before you can realistically, ask the bank to start working on that. You need to be, at least fairly certain that that there's a deal to be done.
Right. So what if you're looking at a deal? I mean, ignoring the sort of invoice, like confirming invoice approval. Invoice approvals. Like what do you guys need to see when you're first looking at a deal? Is it quite simply just AR listings or?
Yeah, so pre-term sheet, let's say, we would look at financials, AR, and we'd get them to show us a CRA report. We
just make sure they're current.
We like to know early on if there's a tax problem. Yeah,
I've seen a couple of those lately.
Yeah.
I feel like it's more and more of a thing.
So those three things, and that's enough for us to determine if we want to issue a term sheet. Yeah.
That's fair. So I don't know what time we're at, but if you had, do you have any parting wisdom for the audience? I mean, the audience is all over the map, right? It could be, well, it's currently just my mother probably, but
right.
But
Hi, Mom.
It could, the audience is going to be accountants, lawyers, or pardon me, accountants, lenders, business owners. If you had to leave anybody with parting wisdom, it could be financing related, whatever.
Wow.
What would it
be? Wisdom.
Wisdom, preferably wisdom.
Yeah.
Health advice.
Health advice. Yeah. That's tough. That's tough. Yeah. That's the one thing maybe I should have had prepped.
That's okay.
Prepped for this. I was.
How about specific to factoring? Like if they're considering factoring, I mean, something they should think about when they're trying to decide if it might make sense for them.
Yeah. So I'd say that, a common mistake when looking at factoring is to try and compare it directly to an upline. And it's not that, right? It is really just closer to an early pay discount, right? So if AR's eligible, has been approved, basically the factoring company will factor all of the AR. So the limits that you see are almost arbitrary. It really is just clipping a piece of the margin rather than having to worry about a rate of interest and debt servicing, because the what you pay for factoring only goes up if there's more AR to factor. It's a percentage of that. Yeah. So it can really grow or shrink with the business very conveniently. So that's I guess that's our messaging is generally that. Like, think of it as an early pay discount that is very convenient to use rather than another upline. So
right on. Okay. And where can people find you guys online?
Our website, providafc.com. The socials are just joking. We don't have socials.
TikTok.
Our TikTok is, that's our website. We've got a LinkedIn presence. That's where people. I guess LinkedIn would be the best place. Stuart's email, stuart@providafc.com. He'd be, if anyone had a deal they wanted us to have a look at, he'd be the guy to reach out to, stuart@providafc.com.
That's probably a way I can put that in show notes or something. So we'll figure that out.
One more time, I'll say.
Awesome. Well, thanks for doing this, man. I appreciate it.
And, I appreciate being here. It was good.
We'll bring you back in 6 months once we get this thing polished.
Awesome.
Sweet.
Awesome.
Thanks, Ben.
Thanks, Kyle.